First of all, I want to just thank everybody for joining this discussion on safe agreements, these simple agreements for future equity. We've got two experts here who will spend a little bit of time sharing some insights and fundamentals about safe agreements, and then there'll be plenty of time for Q&A. So I encourage you as we go along here to get your questions in order and make sure that you take advantage of this opportunity. First, I want to introduce Russ Herron. He's a Senior Associate Counsel at the UChicago Office of Legal Counsel. Russ has been working on safe agreements for us at the Polsky Center for as long as I've been here, and is certainly our internal expert. And then we have Galen Mason from the firm Michael Best. Galen is also working with us on several new innovations to our safe agreements. And so the two of them combined have well over a dozen years of experience in working in this area, and will be able to answer all your questions. I'm quite sure about that. Right, Galen? Right, Russ? No issues here? It's going to be
Sure.
home run right out of the box. So I'm going to turn it over to the two of you.
All right, great. Thanks a lot, Dan. I'm going to turn on the deck here. Hopefully everyone is seeing it. So as Dan said, I'm in-house, and Galen is in a firm, and because I am in-house, it means mostly I'm on the investor side in the university in Polsky, and Galen, I think, tends to work mostly for companies. So we hopefully between the two of us, we'll be able to cover the waterfront for you. Here's what we're gonna do today. We're going to give you a little bit of an introduction to safes, what they are, why they exist. We'll talk about the core terms of safes. We'll talk about how they get triggered and what it means when they get triggered. We're going to go through some sort of benefits and downsides to safes as well. We'll talk a little bit about Polsky's form of safe that they use in the NVC. We'll talk about side letters a little bit, and then we'll have some time at the end for questions. So what's a safe? Simple agreement for future equity. That's what it stands for. It was developed by the accelerator YCombinator in San Francisco in about 2013. The idea is to simplify early stage investing. You know, why do you need to simplify early stage investing? Well, it's very challenging for companies to raise money when they're very, very young. You have to sit down and try to negotiate a set of value for your company like you would in a Series A round, and that is very difficult to do, you know, early in the game. And you know, it spares you from having to negotiate with friends and family. If you use a safe, it's a fairly standardized form. It's not debt or equity, so it's not a convertible note. Some people call it a safe note, which is one of my pet peeves. It's not a note. It's a contract. But it is a security for federal securities laws purposes. But again, it's designed to minimize negotiation. There is a standard form of safe that YCombinator puts out. And various places have adapted that, and you can go online and generate your own safe with a safe generator. Galen and I think that one of the things you'll conclude after we go through this is that that's probably not the best idea to just go in and generate a standard safe on your own without thinking carefully about what you might need to change or how it might impact your business. But it is considered to be a pro-startup vehicle.
Perfect. That's me.
Yep. Go ahead.
Okay. So hello, everyone. It's so great to be here. As Dan and Russ mentioned, my name is Galen Mason. I co-chair Michael Best's emerging company venture capital practice. Michael Best is about a 350 attorney law firm. My focus is on working with entrepreneurs and investors. Typically, that means that in plain English, it means businesses that are designed to get big and grow fast. So they're oftentimes losing money, oftentimes for many years, ultimately with a design for an exit. And I say all that because it leads into a safe, and I'm really excited to be here today because it's such this amazing, simple tool. There's some easy mistakes you can make, but we'll cover kind of both the investor and the company side today. On this slide here, though, why do you need a safe? So a safe is really an inexpensive hack for something you might otherwise do. So I just want to give you some quick context here. So remember, the whole point of venture capital is to buy stock in a private company for a low price. You invest in it, you purchase that stock at a low price, and then you hold it typically for years and years, and then you later sell it at a much, much, much higher price, right? Like venture is very risky. You're going to have a lot of wipeouts, a lot of losses. So the ones that are your winners need to sell for 10, 20, 30, or hundreds of times what you originally paid for them. But the key here is buy stock in a private company. When you do, and you'll hear VCs and founders use the term a round or financing. It just means they're creating a new class of stock. They might call it Series C, they might call it Series A, but they're just creating a new class of stock in their business. And then they're selling that to the investors in order to take in the capital. It's easy for me to say that. That is a heavy undertaking, as Russ mentioned. So for an early stage company, that might be an endeavor that's $30,000 to $75,000 in legal fees, and it can go up from there if there's all sorts of negotiations and bells and whistles. So you get into things like, well, who sits on the board, and if there are additional investments in the future, who has a right to invest in those company in that stock, and all sorts of things that go into negotiating preferred stock. And in order to, and that, by the way, as Russ mentioned, requires that you figure out a price for this company. So you may have an idea and someone wants to invest. Well, what's the company worth? They want to buy 10% of the company. How do you know what it's worth? There's this timing issue. So the idea behind a safe, and I think we can go to the next slide, Russ.
Oops, one too many. There you go.
Yeah, right here. So this is just a quick visual of the life cycle that if you start a startup and it's going to be venture backed, this is the road you're likely to go down, or some iteration of this, right? And that blue arrow there, you see where it says VC, means a venture capitalist comes in, and that's where they're going to create a new class of stock, and we'll negotiate that and we'll sell that. So if you're going to spend $30,000 to $75,000 on legal, boy, you got to probably raise $1 million, $2 million and up in terms of justifying that transaction expense. So you can also, of course, earlier here on these green arrows, you could do all that. But if you're only raising a few $100,000 or even $1 million from your friends and family, it doesn't make sense to go to the headache or even figure out what the valuation is. So enter the SAFE, the Simple Agreement for Future Equity. It's a way for folks to invest early in your company, get you started, allow you to quit your day job, pay yourself a salary, hire developers, hire employees, although you may give them equity as well too, which is a different topic. And then those folks' investment in the SAFE, pursuant to the terms of the SAFE that we're going to talk about today, will later convert into this new preferred class of stock in your private company when it gets negotiated around the time you have a VC round, that blue arrow. And the idea is, if you can get a little progress and get down the road, then you can generate a value. You can show some progress. You can show some traction to these investors, and they'll say, you know what, I think that's worth $20 million. I'd like to buy 10% of your company to help you continue on your journey. But a SAFE is an inexpensive way to do that. Ballpark, Russ, I don't know that we've talked about this, but to produce a SAFE, you can find a lot of these generators online. I do recommend that you ultimately talk to a professional, an attorney, either at UFC or finding your own counsel for the company, because they're so easy to use, but a simple turn of phrase can really change the meaning on these. So the good news is it's not particularly expensive to get counsel to sort of help you think through making sure that it's the right document and then that it has the right terms for you. But big picture, what I want you to take away from these first two slides is money comes in early. It's sort of like almost like an IOU that's going to convert into equity at a later date when you have a more substantial institutionalized investment round.
Yeah, right. And so here's a little bit on the core terms of what's in a SAFE. So it is a standardized document, but I think the reality is that while I've encountered sort of the standard Y Combinator safe in the wild a number of times, I would say maybe it's 25% of the time when I see a safe, it's totally unaltered from Y Combinators. And the rest of the time something has been changed. So it's standard, but not uniformly standard. So it's important to keep a track of what has changed in the document, if anything, or is it really the straightforward document? So the core terms they're going to pay the most attention to, I think, are the discount. So what the discount is, what the safe holder, the investor, will receive a discount on the price per share. Based on, the price per share is the price that would be established by the next equity financing round. So the safe holder gets a discount typically off that price. For the NVC safe, it's 80% discount rate. That's not an 80% discount. It's a 20% discount and 80% discount rate. So 20% comes off the price for the NVC safe. The next thing, and you can negotiate that, right? I think 20% is is by far the most common, but it can be negotiated. The valuation cap, if not all safes have valuation caps, not all safes have discounts, and some safes have valuation caps and discounts, like the NVC safe. The valuation cap is sort of it sets a ceiling on the valuation that will be used to determine how much equity the safe converts into when you have that next equity financing round. And that's why it's called a post-money safe. The post-money piece I always find a little bit confusing, because post-money means post the money that the current safe holder has put in. It doesn't mean post the money that's coming in at the next equity financing. It's pre that money. So that's, it's just something to keep in mind. And then there's also a financing threshold. Again, not all safes have these, but the idea would be that when there's a threshold above which the next equity financing round has to go before it would trigger the rights of the safe holder. The NVC safe doesn't have a financing threshold, so it will convert whenever the next equity round is. But oftentimes you'll see a safe will have that concept built into it. So Galen, you want to talk a little bit about how safes get triggered?
Yeah, absolutely. One thing to mention on the last round, just to put this in context, because I know I certainly attend a lot of programs, and I want to just have a few things come away with you. The reason that you have a discount or evaluation cap, as you might have been thinking on that slide a couple moments ago, was if people invest earlier in your business, they should be rewarded for that. And so, and in fact, most investors would expect that. Hey, I was in earlier, it was a lot riskier, so I want some sort of better deal. It's nice that I'm going to convert into this venture capitalist-led financing at a later date, but I want a lower price or something in addition to what they're going to get, because by the time they invest, it's de-risked, and geez, you've already been able to determine a price, but I was here early. So all of those are sort of ways of accommodating the desires of people that are willing to take sort of the riskiest positions. They get a better return. So the trigger. Most often what will happen in a simple agreement for future equity is, okay, someone invests in a safe, say they have a safe for $100,000. And then at a later date, the company raises outside capital. So they sell that preferred private company stock. In our case, let's call it Series Seed. And they sell, say, 500,000 of it. That could trigger the safe to convert. Under most safes that are out there, even if you sell $1 of the safe, it can cause $1 of, the new stock, the Series Seed stock, it can cause the safe to convert. But whether the company sells $500,000 in future stock, $300,000 in future stock, or even $1, you can see how setting that trigger amount higher can determine when the safe converts, and whether you have a discount or only a valuation cap or both dictates the amount of equity that early stage investor is going to convert into. So I like to, it's great if your company side to have hey, if we sell any amount of equity, then the safe converts, because in theory, you want the safe to convert as soon as possible. Because if there's a valuation cap, then the investors essentially have a price per share that they'll never go above. So, imagine being an investor in a startup and you never have to pay more than 50 cents a share, but that company continues doing well. You essentially have an option for that stock to pay 50 cents, no matter what the price goes up to. So when you're on the company side, you want to get those safes converted as soon as possible into equity. Other things that might cause a safe to convert into equity or kind of go away, so to speak, would be change of control, which is sort of lawyer speak for a sale of the company. You might imagine you put these safes out there, and lo and behold, you are one of the lucky few that a company comes along and buys you right away. Well, what happens to that safe? There was no equity financing into which this stock could convert. The answer here depends on the nature of your safe. Did you have a discount or a valuation cap or both? And you kind of go through and ultimately determine they're either going to get the discount. So say in Russ's example before, it was a 20% discount. If the folks purchasing the company are purchasing it for a certain price per share, it would either convert and they get a 20% return in that case, or they may just get their money back. Maybe it's just a kind of a middling exit and there's not a lot of capital to go around. Same result essentially for a direct listing or an IPO. Again, these things are very unlikely to happen in an early stage company, certainly an IPO or direct listing. Sometimes you will see early stage companies sell. It's usually for less than the amount of money that they've raised. So the safe holders are either just getting their money back or kind of getting pennies on the dollar. But so that's why we really focus on the equity financing and causing that financing to cause the safe to convert into equity. Dissolution. I'll mention on that's just if a startup winds down, the safe is treated as preferred stock. So what does that mean? It means that if you have a company and you've raised $100,000 in outside capital and you're winding down the business and there's only $90,000 left in the bank account, typically there's nothing. Startups kind of just disappear off into the night. That 90,000 would go back to the investors first before it doesn't just get divided up based on total ownership. So next slide.
Right. I think you've covered a lot of this.
Yeah, it's all kind of one topic here. So, all around when you issue this safe, great, we talked about that, but what happens? What are the things that cause it to convert into equity? And the equity financing there is the big one. And then liquidity event, a sale or dissolution, those are very similar topics on these two slides.
Right. So what are the benefits? Well, we've talked about this a little bit. Minimal negotiation and thus minimal cost. You're not engaging lawyers at the tune of $30,000 to $75,000 to prepare a whole set of Series A documents. So it's usually cheaper and simpler. It avoids that valuation problem that Galen talked about. You don't have to set a value for the company. People sometimes get confused about that and think that the valuation cap is setting a value for the company, which it's not. It's setting a sort of a ceiling for the conversion for the safe holder, but it's not. If your company is worth, you think your company is worth $5,000 or $5 million, and you've got a $3 million valuation cap, it doesn't mean that anybody thinks your company is worth $3 million. It's standardized, as I mentioned. It's still got some flexibility in it. So it's easy to use. There aren't that many things that you have to worry about negotiating in it. From the company's perspective, it has no maturity date. So unlike convertible note, it doesn't have a fixed date by which it must convert. Usually, I say that because the NVC safe has an automatic trigger provision in it, which says basically that if no event that would have otherwise triggered the safe has occurred by the 3rd anniversary of the safe, then it automatically will convert. That's, you see that sometimes, but often you don't. So there's no maturity date, which also means that there's a possibility, and I think we'll talk about this a little bit more later, that the safe could remain outstanding indefinitely. We've had some startup companies at the university where, because of the nature of their business, and these tend to be science-based tech companies, they are able to fund their business through grant funding and other sources that don't ever involve issuing equity. So we've had instances where the safe just never converted. There was never an equity financing. There was never a sale of the business, and it can sit out there forever. So that's just something to note. Rolling closes, so you're not, because you're not setting a value, you don't have to worry about pegging all of the financing that you're raising to a particular date that's where that valuation was established. So you do a safe this week and you can do another one 3 weeks from now and 2 months later, and it doesn't really matter. Again, it avoids its awkward negotiations with friends and family. And Galen, you want to talk about the 1202 piece a little bit?
Yeah, absolutely. And I think I started saying earlier the cost. There's this note here, Russ, that talks about the minimal cost to use. So how much would you pay a lawyer to use to set up a safe for you? I started to say there's these templates online, which is basically free. Most of the time, in fact, almost all the time, I'd recommend that you have a lawyer look over it with you and teach you how it's going to work in your context. But that might be 2 hours of time. So you're talking less than a couple $1,000s. What tends to come up is you'll end up needing to talk to a lawyer a lot because someone will say, well, can I change this term or that term? But the point being here, you're not spending 30 to 75. You might be spending less than 10,000 or less than 5,000 in terms of issuing these safes, depending on how many you issue and how persnickety the folks that you're issuing to them are when they sign it and ask you questions about it. There is a really powerful tax provision under the Internal Revenue Code. It's section 1202. It's called Qualified Small Business Stock. It governs a lot of venture capital funding in the U.S. And at a very high level, it basically says that if someone acquires stock in a qualified small business, which essentially means it has less than 50 million in assets, which most venture-backed startups will, and they are not in a variety of excluded industries, so you can't be a law firm or a bank or an insurance company, and there's as you might imagine, a host of nuances there depending on the type of industry or product that you're building with your startup. Then if you hold that stock, the investor, including founders, by the way, their common stock, if they hold that stock for 5 years, they get to exclude from even capital gains the greater of $10 million or 10 times their adjusted basis. So it essentially means, hey, some of the startup investing, if you buy the stock, you hold it for 5 years, at least on some of your gains, you may not even have to pay taxes on it. And it is a powerful incentive for sophisticated VCs and a delightful result for some unsophisticated angels when they go to sell their stock and they find out they may not even owe tax. However, remember, I just mentioned there's that 5-year holding period. You have to hold the stock for 5 years. Well, it's not usually a problem. Most private companies are private for more than 10 years nowadays. But the question will come up, does the safe start if an investor purchases a safe, does that start the 5-year holding period? And there's not a lot of precedent here. I typically tell investors not to count on it, but if you were to pull out the safe and read the language in the safe, you'll find sections that say this document is intended to qualify as qualified small business stock under section 1202 of the code, hoping to give the investor the ability to start that 5-year holding period on the off chance that, boy, maybe they only held stock for 3 years, but that my investment was in the form of a safe for the 2 before that. Can we count all that so I don't have to pay tax? So the benefit may be that investors can claim 1202 status. And so that may come up. Ultimately, the investors' tax counsel will have to point that out to them. Downsides. Okay, so why would you not want to use a safe? This is for investors. And this first point here I think Russ covered most of this. And we talk about convertible notes because before safes were invented in 2013, people used convertible notes in the case where they now kind of use safes. And that again comes back to this idea of we need to invest in a company at the very early stages. We don't know what it's worth, and we know at a later date they're going to raise venture capital and create that private stock. So there would be these things. What amounted to a loan that then when the financing happened, it converted into equity. Well, because of the evolution of that model, the convertible note, it came with all the trappings of a note, right? Like, hey, at some point you have to pay it back. There's a maturity date, like your mortgage or a car payment. You have to, maybe it's monthly, maybe there's a bullet payment at the end, and there's going to be some interest. So those are great things for investors because it's nice to get interest. And it's nice to know if things don't work out, you can always just say, pay me my money back. Now, in the real context of an early stage startup, it's kind of silly to invest on a convertible note and think you're going to get your money back. It's not really a loan. We all know this is either going to get big and grow fast, or this isn't going to work and you've kind of lost your money. But that maturity date concept would sit out there, and it did give investors leverage to say, hey, do this for me, or I'll take over the whole company. So that doesn't exist in the safe. There's nothing an investor can do to demand after some time period of their own preferences to have a safe convert. So there's fewer protections in a safe than there are in convertible notes for investors. There's minimal or no control and no reporting. So remember earlier when I described a company, a startup paying a lawyer 30 grand or more to negotiate all these provisions that go into the creation of a preferred stock class. That's about economics and control. So a lot of the things that investors will negotiate will say, hey, I'm going to be on the board and here's 10 actions you can't take without my control, even though I, as an investor, am only a minority shareholder. You can't sell the company, you can't raise more capital. And by the way, you're going to have to every quarter send me your financials and send me an update on the business. Things that if you were investing in a company would come to mind for you. Boy, I kind of like these things to know that where my money went. But when you as an investor invest in a safe, there's no control over this business. There's no obligation for them to send you reports each month. How are they doing? It's just a way to place an inexpensive early bet. Russ mentioned earlier, because there's no maturity date, and because it just has these terms that say, here's when it converts into equity, and some of those things may never happen. It's possible that a safe just hangs out there forever. If you're using a valuation cap, I think that's highly unlikely, but it's theoretically possible. And then let's see, you can lose money, of course, on safes and preferred stock as well. So that's of course like a risk you always take in the early stage financing startup game. And then questionable 1202 treatment. I know I mentioned on the last slide that was one of the benefits, is that you may be able as an investor to say, hey, 1202 treatment starts, the 5-year clock starts when you invest in a safe. But that's not certain. So if you really want to make that certain and that's important to you, and not paying taxes can be very important to some investors, then you want to have to create and purchase actual equity, because that definitely does start the 5-year holding period.
So downsides for the companies. So, simple, not really. It can be simple, but it's not always simple. And so the name's a little misleading. It's also not always safe from an investor perspective. So there's plenty of complexity that can occur when triggering events happen in the safe. Usually the equity financing piece is the most straightforward and the one that is easiest to figure out and predict what's going to happen. Some of the liquidity events, so changes of control, sales of the company, can result in odd things happening. So, it's pretty common if your company is young and being acquired that the acquiring company is not going to pay you just cash. They will probably give you cash and stock in the acquirer, or maybe just stock in the acquirer. And so what happens to a safe when that happens? What if they give both stock and cash? to the shareholders. How does the safe deal with that sort of thing? Those things can happen, and they're not always easy to sort out, and they can sometimes lead to surprising results. It's supposed to be a standard form. It's not really a standard form. You see plenty of deviations from it out in the world. Most of the time it sticks pretty close to the original, but not always. And I've seen some people take a safe and turn it into a completely different document that doesn't really, it uses a lot of the same safe terms, but it's a more of an option than anything. And then downstream effects, infections. Usually a company, the first person who takes a safe in the company, may set the terms, and then the company is pretty likely, either because it's happening simultaneously or to save costs down the road, they're probably going to use the same form of safe that they use for the first person, and that might be fine. It depends on what you negotiated with the first person, but it may also mean that you end up giving to a whole bunch of investors things that you would rather have only given to the first one, or to as few investors as possible. The template safe was developed for corporations, but we've seen plenty of startups that are formed as limited liability companies. Polsky has an NVC safe that's sort of tailored to LLCs. The only real difference is really terminology, because LLCs obviously don't have stock. But it can help to have a safe that's tailored to the actual form of your company if you're operating as an LLC. And then just the last thing to mention is, and again, you may have some more insights into this, but just tracking non-standard safes. If you have you've gone out a number of times and raised money with safes, and each one is different, how do you reflect those on your cap table? How do you track all the things that are different? Different safe holders might have different rights, or might be treated differently when the same triggering event occurs. So you just have to sort of manage that, and it can easily get more complicated than you'd like.
Yeah, I agree with all that. Safes are fantastic, but be sure you have someone to help you, because they can be misleadingly easy to use. A couple points, and also, they're a little bit credit cardish. Like, it's real easy to do a safe here, a safe there. That rolling nature of safes is fantastic, but keep track of how much you have out there, because it's real easy to wake up one day and think, oh, I accidentally sold 40% of my company, and I didn't realize I was doing this. It was so easy to bring that capital in. So understand what they're going to convert into and what the terms are, because you are selling future pieces of your company. The other thing I'll mention too is safes. You can drop them on LLCs. It works. Be careful with how the terms apply, and also be sure, if you do that, be doubly sure that you have a tax accountant that knows how to handle early stage safes and works with LLCs. You can wind up getting a surprise tax bill when you convert to a C corporation if you've been essentially taking a bunch of deductions because you're the only owner with outside safe money. Okay, so side letters. Just a quick minute on what is a side letter. Side letter is, as its name implies, is like a side agreement. And because safes are so simple and they don't touch on all these complex things that parties to a venture deal may want or ask for in an early stage financing, it is not uncommon to sometimes see one party, the company, offer or an investor demand, hey, it's great that we're keeping it simple under the safe, but there's some basic things that I need in order to make this investment. And so just know, first of all, that may come up. And then some of the topics that are most likely to pop up in that context include pro rata rights, which just means if the venture investor invests, then they want a right to continue to invest. So if the company goes and issues more equity at a future date, which very often happens in venture-backed startups, they go through 1, 2, 3, 4, 5 different rounds and up of financing as they increase the value of their business. That investor has a right to acquire that stock before the company can go to others. And that's a powerful right? In venture, there's a lot of losers. And so it's a common strategy and a common theme for investors to say, when I do invest in a winner, I want to double down and keep putting more and more money into that. And so that's a very valuable right you shouldn't give away quickly.
Yeah, Galen, one other thing just to mention on that,
Yeah.
I think it's clear, but pro rata rights, they have to pay for the shares that they acquire to keep their same level of ownership. It's not a anti-dilution provision. It's a right to purchase, so it's not a giveaway.
Correct. Yep. Information rights I mentioned earlier. Some investors, the SAFE doesn't say anything about, well, how often are you going to call me and tell me how the business is going? Are you going to send me the financials? Can I sit in on board meetings? So that's something that you might see in a side letter that just basic information rights that don't come included in the SAFE. A most favored nation provision, or MFN as it's commonly called, that essentially says, hey, I'll invest on this SAFE, but if you give anyone else better terms, then my SAFE converts to those terms too. That one, while I think it sounds eminently logical, of course I'll give that. How could I argue against that? It is a very dangerous term to use, at least on the company side. It's fantastic if you can get it as an investor, simply because startups evolve, they get bigger, they're designed to grow big, to get big and grow fast. And so the terms you may be willing to give someone in the early stages are going to be pretty bad because you need the money. And so if someone else gets better terms at a later date, or someone else gets an MFN added at a later date, it can cause that those draconian provisions, which essentially amounts to giving up more control and selling more of your business, to flow through to larger chunks of cash that you take into your company. So be really careful with that one. And then we say the kitchen sink here just because I've seen anything and everything dreamed up. It can be PR, publicity rights, things like that. All sorts of things can go into a side letter. So if you're asked to sign one or you're given one, be sure you read that as carefully as you might a SAFE. And then the other thing that always drives me crazy is side letters are notorious for not having a termination provision. It'll just say everyone's focused on what are the rights that the investor gets under this side letter, and no one will think to say, hey, when do these rights terminate, right? So if they don't say when they terminate, the inference under U.S. contract law is that they last forever. So you need to be careful with that. And again, use counsel to make sure that you're tracking provisions in these side letters.
Yeah, just one other thing to mention is that side letters are usually used to sort of add additional rights for the investor, but they can also be used to alter the rights under the SAFE as a sort of a sneaky way. So, for example, you can have a SAFE that typically says that the SAFE can be amended if you're doing raising from multiple investors at the same time. The SAFE can be amended if a majority in interest of the SAFE holders agree. So I don't, as an individual SAFE holder, have to agree as long as the majority in interest of SAFE holders do agree. But you can change that in the side letter, so that even though it says that in the SAFE, in fact, you have to get my consent to amend my SAFE. So it's just important to keep in mind. It's just another way of saying, make sure you read that carefully. So I want to make sure we have enough time for questions. So I'm going to kind of go through this pretty quickly. But one thing I want to mention is we're talking about SAFEs generally, not necessarily NVC SAFE. So, and in fact, Polsky uses different forms of SAFEs and different forms of side letters for different programs. So the things that I've said are in the NVC SAFE or NVC side letter are currently, but they might not be in the SAFE or side letter for GSIF or some other university program, and just want to be clear about that. But the Polsky NVC SAFE uses it's a cap and discount SAFE, a standard $15 million cap, 80% discount. As I mentioned earlier, it has that 3-year automatic issuance. So if nothing has happened by year 3, it can automatically convert. There's a different version for, I don't think actually for NVC this is an issue, but in other programs, there's a difference between one that where all the money comes in a lump sum and another where it might come in milestones or something. So there's some differences there. And there are also differences, as I say, between the corporate form and the LLC form. And then on the side letter, the NVC SAFE does have pro rata rights in the side letter. and it does have some pretty basic information rights. So where do you go for more help? Well, there's a bunch of stuff on the internet. Galen's firm, Venture Best, has a site with some great resources on it. YCombinator has a safe user's guide. I find the YCombinator guide to be pretty dense, not the easiest thing in the world to deal with. Cooley-Go has stuff on the web. Carta has some pretty good company-friendly explanations and support documents. And then in Google, there's all kinds of stuff on the web about safes that will help you decipher some of this. So why don't we stop there? And if people have questions, we're happy to take them.
There's a couple here in the chat. It looks like, Russ, you want to cover those?
Yeah, I didn't see them. Go ahead.
Yeah, so I'll read this, and then first, also, of course, we're not giving, at least for Michael Bass, I can't give legal advice, so I'll speak sort of generically and check with your counsel. But the first question I see here is, where do you book it on the balance sheet? I think the primary distinction that people get confused on is it equity or is it debt? I do not usually see it booked as debt. You want to attempt to try and characterize it as debt or as equity, but I would check with your accountant on that. That gets outside of my bailiwick. But back to that 1202 provision, you're going to want to try and characterize it as much as possible, even though it's a dubious position, as equity. The next one, the MFN applies to later investments, not previous investments. Correct, right? So typically, while I've seen retro MFNs, you always kind of got to look at the language. If you're applying a retro MFN, you might as well just ask for the terms that someone else had. It's really worrying about people that come after you that are able to negotiate a better deal.
Yeah, and the other thing we didn't mention on MFNs is that if you're a safe holder with an MFN, you burn it typically when you use it. So it doesn't sort of perpetually exist. You get the better deal that the subsequent investor got, but not all subsequent investors. And so I know that when we are as a safe holder, when the university is sort of looking at whether we should use our MFN, often it's very clear. It's typically, the company did issued another safe, and it's got a lower valuation cap than we have, and so it's kind of a no-brainer that we would take that, and if all else being equal. But sometimes it's not that, and it's not so straightforward, and you have to make a judgment about whether you think using the MFN to get some term that you don't currently have is a good use of the MFN or not. I don't see any more questions. People can feel free to post them in the chat or go off mute and ask them.
Could I just one quick follow-up question about the MFN stuff?
Sure.
I'm curious if you've seen from UChicago or otherwise how people generally treat MFNs in the case of like a company going through NVC and then later going through Techstars or YC, which have like kind of weird terms. Like the new YC deal has two different safe notes that are part of joining the program, and just sort of how that tends to get treated.
Yeah, that's a good question, and it has come up. I don't know that there has not been a statement by Polsky or a decision by Polsky to say that we will waive our MFN if the trigger for it is you getting into another accelerator program. I think some people have asked that question. Is it your policy that if the company gets into another accelerator after winning NVC, do you just waive the MFN for that? The answer is no, not automatically. And what we've done in the past is tried to work out a way to deal with it. It doesn't make sense because a lot of those accelerators have, their safes are very specific to what they're doing. A lot of them sometimes have programmatic terms about participation in the program. So it doesn't actually work for us to just say we want that safe. So you end up having to negotiate it anyway a little bit. So what we're likely to do is, this is all subject to whatever the Polsky business folks feel is the right thing to do in the particular moment, in the particular situation. But we would focus on the pieces of the safe that are sort of standard safe terms that are objectively better through the accelerator program and ask for those, but obviously we wouldn't be asking for terms that don't really apply.
Thanks, that's interesting.
Any other questions? Seems like not. Okay. Well, thanks everybody for coming and tuning in. And certainly if you have questions or follow-up things you want to ask us, you can get in touch with me or Galen through Lucas or directly. Thanks a lot, Galen.
Thanks, everyone. Yeah,
Thanks,
thank you, Russ.
Galen.
It was fun.